Hello, everybody. Dan D. Federicis from Saratoga Report. I've got a special guest with us today. One of the first times the first time he's been on any of these interviews that we've done over time with Saratoga Report. Anthony Ianniello of Ianniello Anderson, PC, a law firm that's well known in the Capital District. They have offices in Albany, Clifton Park, Saratoga, Glens Falls. Anthony, you've got the Northway covered and beyond. How are you doing this morning?
Great. How are you?
Very good, very good. It's kind of exciting for me. We haven't had a chance to do this before, so I'm excited to see where this takes us. And get into this, you wrote an article in the Saratoga Business Journal, "The State of Real Estate in the Capital Region," and it was both enlightening and a little sobering at times. And I wanted you to see if you can expand on that a little more about the things you said there. And you started off by explaining that. Unlike the stock market, the real estate market is, of course, local. However, you then pointed out that there are many national factors, especially in the financial world, that do affect this local market. Did you want to expand on that a little bit?
Well, you can start at the top of the pyramid, which is the Federal Reserve. The Federal Reserve is the arm of the government that sets monetary policy. And Congress is the arm of the federal government that sets fiscal policy. So at the top of the housing pyramid is mainly the Federal Reserve. And I think it's pretty well known that over the last 10 months, the Federal Reserve has raised interest rates 500 basis points, or 5%. A never before such a rapid increase in interest rates, not only in terms of it being done every month for 10 months, but raising every month for 10 months. And of course, this has had many unintended consequences. But let's talk about the intended consequences. The intended consequences by raising rates to this level is to try to dampen inflation. Most people will recall that a year ago, the Federal Reserve indicated inflation was just transitory. It wasn't going to last very long, despite the fact that many economists in very prestigious institutions were advocating that the Fed raise rates gradually. So there was this conflict in opinions between most of the well-known economists and the Federal Reserve. Federal Reserve said inflation is transitory, it's going to go away. The economists were saying, you're wrong, it's not going away, and it's going to get worse. Federal Reserve did wake up, and they did acknowledge the mistake they made. And now they've adopted an economic policy to correct the mistake by raising interest rates. And the intended consequences are to dampen demand for products and services. Because if those products and services are more expensive because the carrying costs are much higher than they were, dramatically higher than they were in a very short period of time, then that should dampen inflation. And I think the Federal Reserve was hoping that we would enter into a recession. Their hope was a soft landing of a recession, but nevertheless, they wanted a recession. And that would, in general terms, always reduce the demand for products and services. So once you reduce the demand, then inflation should subside. Inflation at one time was over 10% on a year-to-year basis. And before, inflation was around the 2% marker. And that's the goal of the Federal Reserve, which was to dampen inflation to the extent that it would be around 2-3%. So thus far, that hasn't occurred. What are the unintended consequences? Well, the first shoe to drop was residential housing. Most mortgages are involved in home purchases. So the buyer has to go to a lender, obtain a mortgage, and that enables the buyer to purchase the house. 18 months ago, the interest rates were 2 to 3%, and recently they've gone as high as 7%. So consequently, the cost of a mortgage has made home ownership really impossible for a lot of people. And then we have the added inflationary pressure of material costs and labor costs affecting the housing industry. So for new home construction, now we have a problem with the cost of the home. So between the interest rates and the increased cost of new homes, we've had a situation where the number of buyers has dwindled substantially. Now we're seeing what limited deals there are. Many of them are on a cash basis now, probably close to 40%. And that really hasn't occurred before. But underpinning the housing market has been years and years of inadequate construction of homes. So consequently, we're faced with a very deep inventory shortage throughout the country, not just the capital region. So despite interest rates being as high as they are, there's been relative price stability for homes because the inventory is so shallow. I don't know how that can be corrected in the near term, maybe not even in the medium term. So I expect there's going to be an inventory shortage for quite some time. Builders have pulled back on the number of homes they're building because demand has subsided because of the interest rates. Also, the interest rates for the builders to carry the infrastructure, that's become much more expensive. Now, I'm talking about an increase in carrying costs of 300 or 400%. So something that might have been 2%, 2.5% not that long ago is now over 8%. So consequently, the builders have been hit with much more expensive costs to carry the project with interest. At the same time, their material costs and labor costs have expanded dramatically. So now a home that might have cost $400,000 18 months, 2 years ago, now that home is over $500,000. Exact same home, nothing different, just a big difference in price. So once you increase the price of new home construction, you decrease the number of buyers, and that seems to be what the Federal Reserve is hoping for. So housing is always the first shoe to drop when the Fed decides to raise interest rates. The rate that's the most comfortable is around 5%. So if the rates drop down to about 5%, then there should be more activity. But right now, it's very difficult. Many of the banks and non-bank mortgage lenders have laid off tremendous numbers of people throughout the country because the number of applications has dropped dramatically, probably not even 50% today of what it was 18 months ago. So a lot has happened in the housing market nationally over a very short period of time, and none of what's happened is good.
I've got a question for you. It's going to put you on the spot a little bit, but if you've got a young couple, a young person who 2 years ago could have afforded a house, I'll specify Saratoga County because we've really seen the prices just crazy here. What would you tell them to do? Obviously, they have to either wait or come up with a different plan or something. What kind of advice would you give that person that's looking at these high interest rates, the staggering costs? I mean, it's staggering is the word I use every time I see a new build or just a home for sale. Like you said, it was a certain price a year and a half ago, and now it's just crazy. What would you tell them?
Well, of course, on the resale market, prices for the most part over a 3-year period, the prices are probably 35, 40% more on the resale market. and with a greater percentage increase with new home construction. So for the young person who previously might have been able to afford a house in the $250,000, $300,000 range, those houses, for the most part, don't exist anymore. So they're going to have to look for a location which does have a supply, small as it may be, of lower priced homes. And in Saratoga County, there are cities and towns along the river, the Hudson River, Waterford, Mechanicville, and so on, up through Warren County. There are houses that may be available in the price range that they can afford. But elsewhere, they will have to have a sufficient down payment, and then they'll have to qualify for the mortgage. Qualification is obviously more difficult because the monthly payment is higher, and most people buy in accordance with the monthly payment, what they can afford. And then if the home is located in a homeowners association or a condo, then there's the homeowners association assessment that has to be taken into consideration in the qualification process. So it's very, very daunting. Some lenders have programs which try to assist the first home buyer. And so the young couple should go to their bank and ask what it is that they're qualified for, so they would get pre-approved for a mortgage in a certain price range. Then once they're pre-approved for that price range and know how much money they can put down, then they can begin the process of retain a realtor and shop and see if they can find a house in the price range that they can afford.
Thank you for that. That's it's logical. That's maybe what some people need to hear. And obviously, this isn't your exact area, but I guess one option is to wait it out, right? If they're renting, keep renting and see what happens in 2 years.
Well, I'm not sure that things are going to change that much. What are the components and the moving parts here? You start with inventory. Inventory is not going to change very much. There has been a shortage of houses being built for many years because most of the towns in the capital region and the suburban areas especially, they have discouraged growth. They feel that the builders should be building $1 million houses on large lots for everyone. And of course, that market is a very small market. So the builders have been forced into building on large lots and expensive homes. And now there's only so many of those homes that can be built. And density has been a bad word for most of the planning boards. So consequently, that moving part of inventory is really not going to change very much. And you'll see on the resale end of it that for sellers to be selling a home and leaving a 3% mortgage to buy a home that's exactly the same, but just much more money and pay 6 or 7% in terms of the interest rate makes no sense whatsoever. So sellers are not selling, and that means that buyers can't buy what the sellers are selling. So from a new construction point of view and from a resale, the component of inventory, that moving part, is not going to change very much. So what might change? What might change is in the new home construction market, it may be that material costs and labor costs will decrease somewhat because of the recession that most economists are predicting. Once the recession hits, then obviously the purchases of materials and the use of labor will diminish, and that should be reflective in perhaps a lower priced home that can be on the market and built by the builders. The other component is interest. Well, of course, if the Fed keeps jacking up rates, which is expected, the pause that the Fed went into yesterday is probably temporary. They've indicated that they expect rates to go up in the next two Fed Reserve meetings. So that was one of the reasons why the stock market took a hit in the last couple of days. So I don't see very much movement at all in the next 3 or 4 years.
That's why I mentioned sobering. You talked about in your article. You talked about the multitude of local governments overlapping and how that creates a hindrance to new builds and so forth. If you had a room full of town, village, city officials in front of you right now, what would you say to them as to what they could do to help alleviate this problem?
Well, the Capital District has been the subject of more than one report and analysis, and they've tried to change the thinking locally because we have over 700 municipal entities just in the capital region. A similar sized area like Rochester has one. So everybody wants their own school district, their own police force, their own planning board, their own zoning board. I mean, you could drive 5 miles one way or another and you're in a different town. And they're all involved with political machinations. And one of the areas that has been discouraged is density. Density usually is achieved by a planned development district, and that's a separate geographical area within the zoning code. But most of the local governments really discourage planned development districts because they don't want density. So that it's a problem that's multiplied in the capital district because of the multiplicity of governmental agencies. So it's very difficult to get approvals, and because of that, and because of the attitude toward density, that has contributed to the housing inventory shortage.
Do you think that there's obviously a need, there's a problem. Do you sense any positive movement possibly happening, even if it's just in pockets?
All the towns recognize that there's a problem with housing inventory, that workers and teachers, firemen, policemen, construction workers, they all have to live somewhere. But the cost of living has risen so dramatically that they're not in the housing market anymore. So there's a lot of talk about workforce housing, but it's just talk. Very little has been done to really solve the problem, nevertheless address it.
Well, that's. I think we should continue this conversation so we can continue on it, because this is such a pervasive problem. It's real. It's home. It's for everybody. We all know people that are in this housing situation where they're renting and they'd like to buy but they can't. This is such an important topic that we can't let it go.
Of course, what's happened with the lack of affordability of homes has become the proliferation of apartment construction. Okay. And apartments have stepped in to fill this void of housing. But apartments that are new are expensive. And generally speaking, there's no portion of the rent that is tax deductible, as opposed to the interest on a mortgage for one's residence.
Right. That puts people in a bad spot. Before we go, can you touch on the Airbnb effect and how that is affecting this housing problem? All the people buying homes and not living in them, but not even renting them for apartments, they're Airbnb places.
That's a whole different area. Many people that have homes are trying to generate extra income so that the maintenance and the carrying costs of a home can be less expensive. And so that's how Airbnb came about. And it's been a very successful company, has a huge market cap. So obviously there's a great demand for people who want to use Airbnb, and there's a great supply of homeowners and apartment owners that are willing to have their homes and their apartments available for Airbnb. Again, it's an affordability issue and a supply issue. And Airbnb has stepped in to capture those two components of affordability and supply.
Well, I think we should continue this discussion at another time because it's too important not to focus on, and we don't get this too often. You've got the knowledge. The article, folks, is in the Saratoga Business Review. It's also linked off Saratoga Report. I think you should read it, although you heard quite a bit about what Anthony has to say about this. And I'm glad somebody in the Capital District is talking about this from your perspective, from this particular perspective, because I don't think we've heard too much from this perspective, at least not in the media. So thank you for joining us today, and let's continue this.
Thank you.